And Ghana's central bank is soon to introduce a standard procedure to calculate interest rate among various commercial banks in the country. The governor of the Bank of Ghana, Dr. Ernest Addison, however, called on the banks to improve on their efficiency and operation costs, irrespective of the module to be introduced to ensure a reduction in interest rates.
In 2012, the central bank drew up specific guidelines on base rate computation. This was later revised in 2013 and has been implemented for 5 years. The Bank of Ghana, in consultation with the Ghana Bankers Association, GBA, is reviewing the existing base rate module and will develop a new framework to determine the base rate. The objective of this review fulfills the central bank's commitment to move towards a more market-based module of setting the base rate in the medium to long term. Its implementation is supposed to replace the current base rate module. This means that commercial banks are not expected to calculate their own base rate, but rather price their credit upon implementation of the Ghana reference rate by adding or subtracting risk premium. The governor of the central bank, Dr. Ernest Addison, said although a new module is in the offing, the onus lies on commercial banks to also improve their efficiency to ensure that interest rates are reduced.
So we have looked at it, and we have had some refinements on that model. I think we may decide to put it out very soon, but I don't think that you really need a model really to get the banks to do the right thing, because if banks want to keep interest rates where they are, they will provide justification, right? They will provide the justification on why they think that even though this is the base rate that is coming out of that model, this is my assessment of the risk premium associated with this or that. So this is why we haven't been that quick in pushing, this movement to the new formula per se.
He hoped the presence of bigger and resilient banks would also address the high lending rates in the country.
That is where the crux of the matter is. If we are able to have banks that are more efficient, irrespective of the model that is in place, you will see lending rates coming down. And this is why we are also pushing for larger banks, so that we will derive the economies of scale from the high operating cost environment as a way of addressing the high lending rates in the economy.
The Ghana reference rate, which would be influenced by current Treasury bills rate, the Bank of Ghana policy rate, interbank lending rate, and inflation rate, would replace the current base rate setting for commercial banks. The Ghana reference rate would be applicable to any newly contracted loan by a customer from next month. It is believed that this module would also help address the challenge of static rates when all the variables are going down.